Hi, folks. Navy Dowdy here in the great Midwest in the fabulous United States for this week's tax tip. Sometimes tax planning can be easy. Open an IRA and it reduces your taxable income. Other times it can be quite complex. Cost segregation on a building means hiring an engineering firm and having a structure broken down into many components on paper with each value separately listed, the frame, the wiring, heating systems, etc. And taking the write offs generally much faster than simply taking a standard approach. Those are both ways to lower federal or state income taxes. For the people who have made large amounts of money or have larger estates, the year to year tax bill is not nearly as much of a concern as the death tax bill. Planning for them can be complex or simple as well, but the tax they are trying to avoid is the largest tax they will ever face and could collectively be more than all the annual federal income taxes that they ever paid during their lifetime. Although technically it'll be their heirs who actually pay it as they are deceased. One such planning trick that these people often use is to arrange legal ownership of their companies or assets so that it's broken up into parts. Then they can claim to the IRS that the parts have much less value than the whole and gift those parts away while still living to trusts, children, and other heirs. Those steps look like this. 1. Take almost any kind of investment, a private company you own, a piece of real estate, a stock portfolio, and put it into an LLC or other legal entity. 2. Divide the LLC into pieces and spread it among your heirs or trusts created on their behalf. 3. Claim that the combined value of the pieces is less than the value of the whole because no one entity controls the entire investment. Some advisors insist that their client's stake is worth 30 to 40% less than it would otherwise be, with bigger discounts for smaller stakes lacking voting power over the LLC. And 4, later, perhaps after you die, your family can get together and sell the entire asset on the open market and profit from its real, non discounted value. This works even for an LLC containing publicly traded shares that, if they hadn't been locked up in the LLC, could easily have been sold off for their full value. Tax planning means different things to different people with a goal of avoiding different kinds of taxes in different situations. It has to all be legal and ethical. But there's one constant, one thing across the board that's true for everyone. If you haven't hired a tax planner or a financial planner that's tax savvy, then you won't know what's possible and you might pay more than the folks who have engaged a planner. I'm Navy Dowdy, and remember, less tax, better life.